So hello, do you think the oil price is high now? You ain't seen nothing yet. Back in 26, I learnt a new word, lustrum, and it means a 5-year period. And given how long decades are, I can't believe lustrum doesn't find more use. And even if we don't actually use the word, we investors often think in terms of lustrums. Many of the investments we make are made with a 3 to 5 year time horizon in mind. And that's precisely why I started using the word. I'd identified a trade of the lustrum. I wrote about it in Money Week. It was oil. So how's it doing? Now, oil still looks cheap relative to most other assets. It's doing very well is the answer, but it hasn't been an easy ride. At times, we've had to bury our heads in the sand. Crude was in the mid-30s when I tipped it, but at one stage I found myself $60 underwater. How is that even possible? You might wonder. Well, of course, oil went negative back in 2020. But like all normal humans, when presented with facts we don't want to hear, we put our hands over our ears, shout blah, 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 fish cakes, and I went and played table tennis. It wouldn't last, I thought, and I was right. Well, in fact, I probably should have bought more. Now, my reasoning back in March 26 was that oil was extraordinarily cheap relative to other assets, be they stock markets, tech stocks, houses, gold, or even other commodities. It could go lower, but then again, it might not. But it was an anomaly that it should be trading at the same price. It was trading at the same price it was in the 1980s, and given how much money has been printed since the 90s, it was just not right. So anyway, here we are, 6 years later with oil, 3 times the price, more or less. How's the trade looking now? Do we sell? I'd say it's maturing nicely, but to use an analogy, although the wine in the cellar is getting finer all the time, it's not yet at its most drinkable. And I want to look at some long-term ratios now, starting with oil against stocks. And this chart shows how many units of the S&P 500 you can buy with a barrel of West Texas Intermediate, WTIC. That's the US benchmark. Currently, you get 0.03 of an S&P unit. That's 4,135 is the price of the S&P for a barrel of oil, which is $114. When this chart is falling, oil is getting cheaper relative to stocks. When it's rising, oil is getting more expensive. So you can see that it fell through the 80s and 90s as the oil price declined, yet it rose through the noughties as the oil price made its way from $10 to $150 a barrel by 2008. You would expect this ratio to fall over time as oil production techniques improve and stock market valuations increase as economies grow. Nevertheless, we are nowhere near the sell zone. If anything, we're still in the buy zone, even with these recent increases. The ratio is at the same price it was in 2002. So there's no reason here to sell our oil and move the money back into stocks. Call me again when the ratio is at 0.07. That's another way of saying I see oil getting at least twice as expensive relative to stocks as it is now before this is over. If the S&P 500 is 4,000, a 0.07 ratio gives you an oil price of $280. Mark my words, $300 oil is not such an outlier. Right, here's the WTIC against the NASDAQ. And again, you would expect NASDAQ valuations to improve over time versus oil because of the scalability of digital and the growth in that sector. But on a relative basis, oil again looks very cheap and is still a buy. Using the ETF VNQ as a proxy for US housing, here is crude against US housing. Since 2004, it was 3 times higher before the end of the last bull market. And finally, here is crude against gold. How many ounces can you get for a barrel of oil? And the answer is 0.06 of an ounce. This ratio tends to be much tighter over time. Just as oil production techniques improve, so do gold mining techniques, and there isn't the growth of companies factor to push it lower. We are somewhere in the low to middle of the range. Call me when it gets above 0.1. If gold is $1,850 an ounce, that would mean oil at $185 a barrel. It's not just relative. There are strong fundamental reasons for oil to go up too. We've looked at relative valuations, of course, already. What are the fundamental reasons to expect a higher oil price? First, there's 14 years of money printing and inflation. A lot of that money is going to go into the basic human requirement, that is energy. Even if they print less, the money's still being created, and oil is essential. Unless there's a sudden 2008 style debt destruction moment, that money will still remain in the economy. It's just more of it will go to oil. Second, despite the fracking revolution and the improved productivity it brought about, for almost 10 years now, there has been huge underinvestment in the sector. From lack of new discoveries through to pipelines and basic infrastructure, this means higher costs. Misguided anti-fossil fuel narratives perpetrated across the media and social media have made this sector toxic. Few want anything to do with it, so talent goes elsewhere, and with it investment, and as a result productivity declines. Governments have exacerbated the lack of investment with their pursuit of green energy and net zero. They're attacking. They clearly don't get it. The narrative now is windfall taxes. That's only going to further disincentivize investment. Policymakers are attacking and blaming this essential industry, not helping it. The Russian invasion of Ukraine has accelerated things, but this was all going to happen anyway. And the hypocrisy of the net zero movement, as I'm forever saying, is that it's going to require the burning of one heck of a lot of fossil fuel to make it happen. So I don't think demand is going anywhere either. Fossil fuel's essential, not for a few years anyway. And the latest news out of oil cartel OPEC has wobbled the price a little bit. I'm not concerned. I'm thinking longer term. So what was my trade of the lustrum is now potentially my trade of the decade. My preferred vehicle to play oil back in 2016 was oddly BHP Billiton, BHP ticker symbol in London, but it's known as a mining giant. Something like 22% of its revenue, 35% of its earnings came from petroleum. And if you plotted a chart of BHP and WTIC, you would see that one tracks the other quite beautifully. However, BHP, for all the reasons stated above, is moving away from the sector, and that's further going to help the oil price, of course, but it also means its use as a proxy is no more. So consider SPOG, the iShares Oil and Gas Production ETF, that's LSE SPOG, SPOG, as a vehicle. Another option is the HAN ETF, Alerian Midstream Energy Dividend UCITS ETF, ticker symbol MMLP. It yields around 6%, gives exposure to midstream energy companies involved in the processing, transportation of and storage of oil, natural gas and natural gas liquids in the US and Canadian markets. So those are two potential ways to play it, and if you buy the story. Thanks very much for watching. Please check out my Substack. As always, please subscribe to this channel, and I'll be back with another video very soon.